In this video, I want to walk you through a simple what-if scenario. What could it have possibly looked like if in 2010, when I started teaching, I put a permanent life insurance policy in place outside of work, something that's not directly tied to the district, not relying just solely on the employer's group coverage. By the end of the video, I want you to be able to clearly see the real lesson here, not just what a policy could have grown to, but what waiting may have cost in premium, time, possibly health, or years of protection that are outside of work. So before we jump in, there's a few expectations to set. First, I'm using a whole life product for simplicity. I'm doing it just because whole life is easier for most people to understand, and it gives us a clean example of permanent coverage with level premium and a death benefit that typically stays in place. Second, the numbers I'm going to be using are based on today. Today's rates, not 2010, so not when I started teaching. This is not to attempt to recreate 2010 exactly. These rates, dividends, and the overall performance could have been different back then. We simply don't know. This is hypothetical illustration just to help show the principle. Third, this is a participating whole life policy, and that means that if the company declares dividends, then the policy owner, you, me, we have the opportunity to participate in the company's results. And so for this example, I'm going to assume that those dividends are used to purchase paid up additions. And what that is that it can be used to increase both the death and the cash value over time. Finally, this is an illustration. It's not a guarantee for future performance, and it's not an estimate except where the values that you may see specifically labeled are guaranteed. It's simply a model to show what could happen under certain circumstances.
Before we jump into the illustrations, one, thank you for being interested and part of this conversation. I know personally, our family knows, and you might know too as well that how important it is that we understand exactly what we're receiving in benefits from our employer. We got to know what transfers with me if I leave. How do I convert if that's a possibility? What would those payments look like in premium if I do leave, if they have to convert my policy? Those things are just so important. And equally important is for us to understand and have a mindset shift that, hey, we're not just talking about a benefit if something was to happen. There's also those living benefits. There's also the cash value that you can have depending on the type of policy that you choose to move forward with. So have those conversations if you're not. It's too important. Your family loves you, and finances are so crucial to just, our way of life, how we have to live, how we have to take care of each other. So have those conversations. If you need help, feel free to reach out. I'd love to have a conversation with you. No pressure. All right, let's get back to the video.
All right, so let's take a look at these two illustrations. On the left side, you're going to see an issuing age of 25, and that's just how old I was when I started teaching. On the right side, you're going to see an issuing age of 39, and that was the age of when I left the classroom. For both of these, we're going to do the same thing with the policy, and so that's going to be a $250,000 death benefit. And we're going to do non-medical, which simply means that as the applicant, I'm submitting information about my health history, and then the carrier is going to match that with the databases that they have access to, just to kind of see and get an idea of my health and be able to determine my eligibility. Okay, now you can do a medical underwriting, and that's just where you would have to go and set an appointment, get some things drawn, get those things into a lab so the carrier can get a full picture of your health. And when you're really healthy, that is a great way to save some money on the premium because they actually know more about your health. But underwriting, you have those two options: non-medical, more simplified issue, you can get it done quicker. Okay. So we have the $250,000 death benefit for the issuing age of 25. If today's rates were the rates in 2010, I could be looking to be paying around $220 a month. That's $2,600 a year. Looking at the age of 39, for that same 250K, my monthly premium would be somewhere around $336. That's about $116 more than if I got it when I was 25 when I first began teaching, if these rates were the same in 2010. Now, that is substantial for many people. Definitely would have been for me and my family. The next thing we're going to look at is this table. This table is going to show the age of the policy, the age of the applicant, and guarantees plus non-guaranteed possibilities. Okay, so if we're on the left side and we're looking at again our issuing age of 25, I'm going to go ahead and just go down to year 14. Okay, year 14 of the policy would have been that same year that I left the classroom. Okay, and that's going to be the numbers that we're going to just take a quick look at. So this column right here on the left side is typically shown as your guaranteed benefits. So you'll see here, death guarantee. This is a $250,000 guarantee, and it is consistent all the way through. They're guaranteeing that much death benefit through the life of your policy and upon death. Okay, the cash value possibility, they're going to guarantee this cash value. All right, this is no interest added, this is no dividends added, this is just the base guarantee. If you were giving nothing in addition than what you've already paid for, this is what it is. Okay, so at that rate, I would be guaranteed about $21,000 when I left the classroom, and I would have still had that death benefit of $250,000. So that $21,000 is something that, I could have had access to, that my family could have benefited from should we have needed it. And we could have used a little bit of that cash. So let's look quickly at the 39-year-old. 39-year-old me. So if I go with the same policy age of 14 years, after getting that 39, I'd be 53, not 53 yet. So we're looking, projecting in the future what it possibly would look like. Now, I'm pointing out this because I don't want you to get tripped up. So you'll see in the guaranteed cash value that is $36,000 compared to the $21,000 on the side where we're looking at the issuing age of 25. Yes, that is more on 39, but we have to remember that I'm paying more because I'm older now. So that same guaranteed amount of 250K costs me so much more now than it would have cost me at age 25. If you're someone who's looking at, man, you pay more and then you have the possibility to get more cash value, and then if you have benefits like dividends or interest on your cash, you have a possibility to get more cash value plus higher death benefits. If that's really looking good to you, then I would say, depending on your age and your health and your whole financial situation, IUL might be something that you would love. But right here in this whole life situation, the point is to recognize that, number one, if I wait, I'm going to pay more for that same amount of death benefit. If I wait, my insurability may be at risk because as I get older, our bodies deteriorate, something could happen. If I wait, I'm losing out on the benefits of that policy throughout that length of time. Well, here is the real lesson for me. If I had known then what I know now, I would have wanted something outside of work that was mine, not tied to my district, not depending on whether I stayed in education, not something I had to think about only after I left. Something permanent, something already in force, something that had time to grow while I was busy living life and serving in education. This is not about saying that everyone needs this exact policy or this exact amount. This is all about understanding the cost of waiting. And that is, the longer you wait, the more likely is that the premium is higher. The protection years are fewer, health declines, and the opportunity to lock something in early, that's gone. That's why this matters. Sometimes the biggest financial lesson is not just what we did, is what we now realize we could have put in place much sooner.